And now we're going to move into our intermarket study. The first chart we're going to look at here is the S&P Volatility Futures Exchange Traded Note. The Volatility Index, or the VIX, is oftentimes called the Fear Index because it gains in value when the S&P drops. The rate at which the S&P prices are changing really has a direct impact on this index's value, the VIX. Since fear is a much more potent motivator than greed, prices tend to drop exponentially faster than they rise. And the faster that the S&P drops, the faster and higher in value that the VIX rises. So the way we utilize this chart is to take notice if the VIX or its indicators start gathering strength and diverge from what has historically been observed in its relationship to the S&P. I know we've talked about RSI quite a bit already, and it proves here to be a useful tool again on this chart. Generally, if RSI breaks up and over the 50 line into bullish or glass half full territory, and it can stay there, this is on the VIX now, then you should be on high alert. Another simple but effective signal is this thick dashed line that's going through the chart, which is the 22-day moving average. 22 days is roughly equivalent to 1 month's trading days. So if price breaks above its 22-day moving average, then again, you really should take notice of what's going on here. And as you can see here on this chart, both of those signals were triggered in mid-February, and they've remained in force since that time. Though the last 2 days rally has caused them or pushed them back down to their respective demarcation points, they do remain in pretty dangerous territory based upon the yellow highlighted points I've noticed and noted for you over the last 18 months. Now here, the second chart we're going to look at is the 20-year Treasury yield. And the reason we look at this chart is because of a long and natural relationship that exists between stocks, bonds, and bond yields. So when people think stocks are attractive, they sell bonds and buy stocks, and vice versa. And the next step in that relationship is that when bond prices go up or down, bond yields move in the opposite direction. So bond prices and bond yields have an inverse relationship. So when bonds are sold en masse and prices go down, bond yields will rise. And so the logical extension of that relationship is that when stock prices go up, bond yields should also rise with them. This chart indicates that's a fairly accurate relationship. As you can see by my vertical lines drawn on here, the yellow circles in the two bottom panels, and then the yellow and green highlights in the top panel, when the 20-year yield trades above its 50-day moving average and the RSI is above 50, which usually coincide, then stocks will do well. If the opposite holds true and the yield is below its 50-day moving average and the RSI is below its 50 line, then stocks typically do poorly. And as you can see down here in the far right-hand corner, the bottom right-hand corner, for the past 5 months, the 20-year yield has been incredibly indecisive. It broke above its 50-day moving average in mid-January, but it really hasn't been able to move anywhere since then. It's bounced back and forth between this triangle area, which is called an ascending triangle. It's pushing prices kind of like a rising wedge, closer and closer together, so at some point soon it's going to be breaking above or below its current area, which will give us a really good indication of which way we can expect the stock market to move. Today it closed at 2.82, so it's challenging its upper resistance of 2.85. That's this straight line across here is 2.85. But keep in mind that just 2 days ago on Tuesday, it closed at 2.73, which is literally sitting right on top of its 50-day moving average. And the last thing I'll say about this chart is, remember that moving below the 50-day would be bearish for stocks, generally speaking. And also, let's look at this RSI, which is also giving us bearish signals. You can see here the trend line, support trend line that I drew, has been supporting this RSI for the past several months, but it broke down and through the support trend line a few weeks ago. And as I explained in the last video, when you break a trend line it reverses its characteristics. So now that trend line is acting as resistance. RSI is moving back up, and it's actually meeting resistance at that trend line right now as we speak. So again, we'll have to see if RSI can break above that resistance and the yield can break above its ascending triangle. That would be pretty positive for stocks, and you could take away that things will probably improve and get better. That's something we'll have to pay attention to. So the last three charts we're going to look at here are of precious metals, the precious metals group, which includes gold, copper, and silver. Now gold is a good proxy for what we call a favorable risk-on environment, meaning positive for risky assets, things like stocks and bonds. Not bonds, stocks, gold, international stocks, things like that that are very volatile. In a risk-on environment will do well. In a risk-off environments, when they do poorly, and things like bonds do well. It's been a pretty good relationship between stocks and gold over the last several years in risk-on environments. So that's one reason we look at that. Now, as far as copper and silver are concerned, they're really useful for a different reason, which is that they're also, beyond just being precious metals, they're also considered industrial metals, meaning they have many commercial and manufacturing applications that they get used for. Now, specifically in regards to the gold chart we're looking at here, the yellow highlighted area, as I've denoted down here in the lower panel, the lower panel is the S&P 500, going all the way back to 1998. This middle panel, the main price panel, is Gold Miners Index, which is 10 of the largest gold miners, not actual gold bullion. I found that this has got a stronger relationship to denote changes with the S&P than the actual gold itself. So, long story short, the RSI again is up here in the top panel. This blue line I've drawn kind of in the middle is at the 40 level. If you remember, anything below 50 is somewhat bearish, anything 30 and under is extremely bearish. So 40 is kind of a demarcation point where things become obviously more bearish than kind of middle of the road, which is what 50 is. And this has proven to be a pretty good proxy. Once RSI dips under 40, and if the gold miner index trades down to touch or underneath this moving average, which is a black line, this moving average is the 100-week moving average. I forgot to mention this is a weekly chart. So again, it's 1 week of data pinned in each data point. If you have that combination of the RSI trading down to the 40 point, that line underneath that, and the gold miner trading down to close to and touching or underneath its 100-week moving average, there's only been a handful of those instances. When that happens, the market is either going down or is about to go down, and usually it's not an insignificant amount. There's been 6 instances in the last 12 to 14 years, 2 of which were the major crashes in 2000 and 2008 and 2009. So if you excluded those 2 major crashes, even the minor downturns in the market averaged about 8.5% down in the stock market. If you factor in the 2 major crashes, then that negative downturn in the stock market ends up averaging 28 to 28.5%. So really significant losses in the market when you have that combination of the gold miners index trading underneath its 40 on the RSI and trading underneath its 100-week moving average. Obviously that's very significant. I wouldn't be mentioning it except for the fact that that's occurring right now. The gold miners index has been trading underneath its 100-week average for several weeks now, the entire year in fact, and it's been bouncing around its 40 on the RSI. It's currently underneath 50 for most of this year too. So we need to really pay close attention to that to see what transpires. The next chart we're moving on to is the copper chart. It's the copper spot price, the actual copper metal itself. Unlike the gold chart we looked at, this is the copper bullion itself. Otherwise, the chart's pretty much the same. It's a weekly chart comparing the price of copper with its RSI in the top panel versus the S&P pricing on the bottom. It goes over the last 14 years. I won't spend as much time on this, but suffice to say that when copper is going, or trading I should say, underneath its 100-week average, in every instance the stock market has done poorly. And that's because copper and silver both, since they're industrial metals, are fairly good proxies for the overall health of the global economy or the macro economy. Copper specifically has long been noted as having quote-unquote a PhD in the economy, because it has so many industrial uses, whether it be in appliances, electrical conductivity for electrical parts, various things like that. When it does well, the economy generally is doing well. When it does poorly, the economy is generally doing poorly or will do poorly. And so if it's trading beneath its 100-week average, we need to pay very, very close attention to that. And again, I'm mentioning it because it's very, very close to its 100-week average. It's been trading underneath it for most of the end of last year, and this year it's kind of hovering around that point. So if we can get above it, that's good for stocks. If we crash or come down below it and stay underneath it, then that's going to make us very skeptical of stocks and the stock market.